So I will have the opportunity to introduce Dr. Michael Swanson. He has presented with us before a little over a year ago down at Haines City. He has his undergraduate degree from the University of St. Thomas, and for those of us who think that's some balmy Caribbean university, it's not. It's from St. Paul, Minnesota. And he has his master's degree and his doctorate from the University of Minnesota in Agriculture and Applied Economics. And to provide us with an overview of macroeconomics, Dr. Michael Swanson. After Dr. Swanson, we will break for lunch. It's a buffet lunch. And then Adam Putnam will be here to speak to us during the lunch hour.
Thank you, Michael. Pleasure to be here. And I'd like to say thank you to Richard and Bob for being willing to switch, helping me get back on schedule with the airlines. Who enjoys flying these days? Isn't it a privilege? Well, it's great to be here today. You know, it's really nice not to have to bring my laptop. I mean, when you work for Wells Fargo as a financial institution, we take data security very seriously. In fact, if you lose your laptop, you can lose your job. And I had a little setback a couple weeks ago. I was traveling with Delta Airlines out of the Denver airport. Who's ever been through the Denver airport? Anybody? It's really not in Denver, is it? It's in western Kansas, right? And I was late getting to the airport, like I'm afraid I might be with the Orlando today, and I left my laptop checked in my bag. Guess what Delta Airlines did? They lost it. So I had to call corporate security and tell them I'd lost the laptop. They were not happy, very frosty, and they said, well, what was on your laptop? I said, all my economic analysis. They said, was there anything of value on your laptop? Everybody likes laughing at economists, right? And rightfully so. Because, you know, when you give a talk, you should do three things to have a successful talk. Have something important to say it clearly, and then stop talking. Who's ever heard an economist not do any of those three things when they give a talk? Well, you know, we're going to talk about the economy, but I want to link it very directly with what we're seeing in Florida agriculture. You know, it's interesting. I have to convince people that they don't know the future. When I used to live in South America, and I found out an interesting thing about taxi cab drivers down in South America. They're all experts in both economics and football. Now, not the same football you like, but they were all convinced that they knew every answer. You know, and the reason I bring that up is we have a built-in bias to believe our own forecasts. What I'm going to try to communicate today is when you look at what's driving the global economy and the U.S. economy, and what's going to link it's going to take into Florida agriculture, it is absolutely impossible for us to predict. Now, I always remind people that my forecasts economically are sophisticated, econometric based, and they're wrong, okay? Your forecasts are common sense based, and they're wrong also. So the only difference between my forecast and your forecast is I'm professionally wrong, and you're amateurishly wrong, right? But we're going to be wrong together. So that's the overarching theme, is I want to talk about the sources of volatility in both the domestic and global economy, why I think they're going to get worse, and what it means to managing more risk in Florida agriculture. So here's an overarching theme. This is the problem that you have when it comes to economics. We made a huge failure when we teach economics. Who's ever taken an economics course? Anybody in this room? Was it taught according to the boring method? That's the officially sanctioned method for teaching economics, the boring method, right? Now, what did they do? Remember the first day you stepped into the economics course and that professor hit the chalkboard running? Equation after equation, right? And then what do they tell you as an economics student? Solve the equations, and there you have the answer. Does it really work that way in the real world? Not whatsoever, right? The problem that you have in the real world is that everything is connected, even though we can't see how it works. Everything has a feedback loop into it. Everything has to keep on going. As I tell people, the most important question in economics that you can ask is, and then what happens? Because the story never ends. Now, you're going to hear a lot of stories. You turn on the TV, we heard a little reference to that earlier today. You turn on the TV, talking heads talking about what Washington must do or what the Federal Reserve must do to save this economy. And they tell you a very simple story, and they say, that's how it works. Really? We know it doesn't work that way. There's so many interconnected feedback loops in the economy, it's inherently unpredictable. Now, what's interesting, though, is to talk about the state of the system. I believe that you can go through phases of volatility, and we need to talk about how that's going to impact us in Florida agriculture. Now, let's talk about agricultural risk, or economic risk if you want. If you weren't interested in agriculture, we just talked about economics, you could ask, is agricultural and economic risk rising? And the answer is absolutely yes. Quantifiably, and to some degree, almost more importantly, emotionally. Think about input risk. How many people in this room buy fertilizer, crop chemical, or diesel, or any other inputs when they manage their businesses? Okay, and the rest of you who are in the business are what, vegetarians, too weak to raise your arms? You know that even if you have predictable output prices, which nobody does, now you're seeing much more volatility on your input prices. So the ability to forecast margin is just disappearing. It's interesting. We work a lot. We're the largest agricultural lender in the country. We work coast to coast. We work in Canada and Mexico now, and we see this everywhere we go. There's not a single market, whether you're a specialty grain producer, whether you're a horticulturalist, whether you're producing fruits, nuts, and berries, whatever you're producing, there's more economic and price volatility. So what are the drivers? The drivers are pretty straightforward. It's going to be more interconnected global markets. And I think this is something we have to keep thinking about over and over again. We can talk about it when you talk about Greek bonds, but you look today, there's more trade between food going on than there's ever been before. We're going to depend more in every single market on both the growth in foreign markets to consume our food and the available supply they used to have to send to us. It's not that you need to export to everybody, but you can be displaced by international trade as well. People get surprised by how you can be collateral damage in a trade dispute that has nothing to do with you. Policies. Where nobody's happy with the way they're running the government. Nobody's happy with the way they're running the Federal Reserve. Why? Because we asked them to run it the way we're doing it. You know, you don't have to look too far to find the source of a lot of the problems. It's people who vote, right? They ask for the impossible. But when we look at the policies, they have a real impact. We're going to talk about that. Lastly, so what are the implications? Let's take a look here. Global economic growth. I'm going to hit this point hard. When you look at food and agriculture, things have changed in a dramatic way. Look at fertilizer. Who in this room uses fertilizer as an input to growing a crop? Okay. Think about how the fertilizer market has changed. We used to be a primary supplier of our own fertilizers in this country. Now, when you look at the global trade in fertilizer, the United States is almost a bystander to what the Chinese and Indian policies are on an ongoing basis. Who thinks they have a good idea of predicting what the Chinese government's going to do tomorrow? Right, the Chinese don't even know, right? So why do we think that in a world where we're going to be connected to all those input and output markets that we're going to be able to predict this? So who are Florida's competitors and what are your buyers? Now, the other thing I want to point out is look at the currency volatility. Another big driver of the agricultural market, and though we don't feel a lot sometimes in some of these domestic markets, is currency exchange rates. And it's not enough to simply say the dollar's weak or the dollar's strong. You have to look at each of the individual currency pairs to understand what's happening. How about U.S. economic turbulence? Nobody feels confident today knowing what's going to happen. Look at the Federal Reserve's gift to us this week, right? Came out and announced their twist. What did it do to the market? Sent it down, what, 8%? Wow, thank you, Federal Reserve, right? Could you do some more economic intervention? Probably get us down another 20%. U.S. turbulence, we know what's happening. Biofuels, not so much here in Florida, but it's a big part of the agricultural world. And speculation. More and more, we're seeing more and more speculation come to the markets. You say to yourself, I'm growing, pick a product that's not a futures traded product. I don't have any speculation in it. Oh, yes, you do. Because there's always alternative linkages back into your market. Everything's connected. And we're seeing more speculation and outside interest coming into agriculture than we've ever seen before. Now, I'm going to start out with this slide because I think it's very illustrative. Look at the impact of trade on U.S. agriculture. What this measures is the value of U.S. exports versus the value of agricultural production at the farm or ranch level. So I went and I said, okay, how much money are we getting from exports versus what's showing up at the farmer ranch level here in the United States. Look at the explosion of value from outside buying. A couple of things have happened. What we're producing in the United States has become much more valuable to the world, which is an interesting consequence of biofuels to some degree, and we're seeing more trade than we've ever seen before. On top of that, the explosion of the global growth of outside the United States, people with more money looking for high quality fruits and vegetables, more competition for what we're producing is making it much more valuable. Now, why would we say this is a two-edged sword? What's interesting, though, is this is probably the most encouraging development that you could see for agriculture. People want to buy what we have and they have the money to do it. The problem is if you get yourself into a trade dispute or if those foreign buyers have a setback, suddenly you lose this market quicker than you do your domestic market, and you see enormous setbacks in individual sectors. So this is a great thing to be happening, but it's also an extremely big source of volatility. Now, where is Florida competing? You know, you can't emphasize this enough to people here in Florida. NAFTA and NAFTA and NAFTA. People forget that the two biggest traders that we have when it comes to agriculture are Canada and Mexico. Over and over again. You talk about China, you talk about Japan, but when you rank it over and over again in every market, who's our trade partners? NAFTA, Canada, Mexico. Who are you competing with? Canada and Mexico. Over and over again. They're the ones. Latin America to a large degree. Why? Because they're in the same fruits and vegetable groups that you're producing here on a seasonal basis. So you have a unique kind of flavor to how you guys are competing. If I go to the Midwest and say, who are you competing with? They're competing with the Ukraine for wheat, or they might be competing with cattle out of Australia. You have to remember, it's all kind of connected to individual products and commodities, and they all have a unique story for their connections. Now, a lot of numbers up here. What I'm going to point with this slide to show you something. We compete in many different sectors. We are major exporters in some areas, and we're major importers in other areas. For example, when we look at consumer-oriented imports, for the longest time, we were net importers of consumer-oriented food products. Well, what's that? Well, it's fresh fruits and vegetables, things that can be immediately put on a plate. It's things like beers and wines. Did you know the single biggest import that we have for agriculture is wine? Right? You wouldn't think that, but it's a $7 billion a year trade that we have with Europe, primarily Europe and Australia. Those little things, not a big deal here in Florida, but if I'm out in our California office like I will be next Tuesday, it's a big deal to them. So we export, we import. And what's interesting is we were a net importer of agricultural products just 3 years ago. Now we're showing amazing growth as a net exporter of agriculture. We are now a net exporter of agricultural value, which means we are creating jobs here in the United States on a net trade basis. We are one of the very, very few sectors that can say that in this economy. It's great news because we know we have a built-in advantage. We have great water resources. You guys have great geography, great ground. You have great management practices. You guys are producing jobs that's growing the U.S. economy. But the problem is it's tied to exports to very, very fickle and volatile markets. Now, if I compare the import to the export, I want to show you that we're not just a net exporter. It depends on who you are and what business you're in. For example, on the bulk total, what's bulk? That would be the corn, that would be the wheat, that would be the cotton, things that really aren't processed. Just put them in a big boat, ship them overseas. We've had explosive growth in our net trade advantage. Now on the consumer-oriented, which is interesting as well, you can see the impact of the recession. What we've seen, for example, in the wine trade, if you go look at those numbers in particular, is people are much more price conscious. There's a lot less $30, $40 bottles of wine coming in from France, and a lot more $10 bottles of wine coming in from Australia, and a lot more $7 wine from California being sold in a lot of supermarkets. So you can see that we've really dropped that consumer-oriented import net trade difference. Now, you can go through these things that are all kind of unique and special, but the net impact is we've done very well in the recent 3 to 5 years because of the growth overseas. Now, like I said before, just to bring this home, look where you guys compete. Where are you guys competing? Typically fresh fruits and vegetables, processed fruits and vegetables, the types of juices. That's a market that's important to the people in this room. That's your competition. Typically it's seasonal, sometimes it's specification. But as the dollars grow overseas, there's going to be more demand overseas for those same products. They probably won't flow to the United States as much as they did before. Going back to what we talked about before, currency exchange rates, another big piece of this. So, I just won't dwell on these numbers, but you can see that Canada and Mexico, they're the big trading partners we have, especially in a lot of these fresh fruits and vegetables and consumer-oriented products. So when you think about who you're competing with here in Florida, primarily Mexico, Latin America, and Canada. You don't have to worry about China. When I'm out on the West Coast, I worry about China for a number of products. Here it's not so much. So let's talk about that competition. NAFTA, biggest trading bloc that we have in food, biggest trading bloc we have in general. Look at the volatility that we've had on GDP growth and look at the forecasts. Now, remember, these forecasts are going to be wrong. But it's interesting because when you look at what's happened on a go-forward basis, Mexico is expecting to have a much stronger growth rate than the United States. And Canada, pretty similar to the United States. But look at that. What would the implications be for people in this room? Think about the labor, because if they're growing faster overseas in Mexico, going to have more indigenous job growth there, maybe more than we have here, so some competition for the labor. They might have higher income growth going on at that point as well, maybe retaining more of the products they're growing there for domestic markets. These are very important complications and developments on a go-forward basis. But what I also want to point out is look at the volatility difference between Mexico and the United States. When they have a setback, they have a huge setback. They're a much more volatile economic response. And I don't think that's going to go away. What's the biggest problem with that forecast going forward? It's that we're lacking volatility. I often call this the 41 degrees in Fargo phenomenon. Who's ever been to Fargo, North Dakota? Show of hands. Well, my condolences, first off, okay. But if you've been to Fargo, North Dakota, let me tell you this. The average annual temperature in Fargo, North Dakota is 41 degrees, okay? As I tell my friends in California, the problem, though, is if you dress for 41 degrees in Fargo, North Dakota, you'll be uncomfortable 3 months of the year and dead the other 9, right? The problem with these forecasts is they don't have enough volatility in them. They don't show you the big shocks. We will have another recession. We know it. Sometimes people are saying we're in a recession right now, depending on who you are, most definitely. Now, what about exchange rates? Because it's not just the economic volatility, it's also what they do to the exchange rates around those events. Look at the impact of that recession. Go back to the last slide and look at the impact of Mexico's recession on its exchange rate. You had a sudden sharp drop in that. That was a response when you have a country like Mexico trying to export its way out of its current problem. Why does that matter to people in this room? Because if you're in a sector producing the same fruits or vegetables or horticultural or vegetable products as they are, and you suddenly have that kind of drop in your currency exchange rate, what does it do to the competitiveness of your products? It's a huge impact, right? So the problem I'm trying to communicate here is we don't take into consideration enough of these linkages on our competition with the global markets. Now, let's talk China for a second, because in agriculture you got to talk China if you're going to talk about anything. Let me say this is a bad forecast. Let me say I was a stock salesman. I wanted to sell you some stock, and we took China off of that chart and we called it Corporation XYZ. What would you think about my forecast for their growth going forward? A little optimistic, right? Nobody grows like that on a go-forward basis, right? You think to yourself, that would be a pretty wild forecast for any corporation to be forecasted. But yet we're comfortable forecasting China to grow like this. Once again, what's missing from this forecast is the volatility. What I think we need to consider is a scenario. This is not a forecast by any stretch of the imagination. But think about the recession that China had in the early 1990s. Who remembers that recession, by the way? Anybody remember that recession in China? Yeah, very few people do. Why? Because in the early 1990s, who cared about China, right? It was a smaller piece of the global economy. On today's basis, think what would happen in agriculture, in the global markets, if China had a 2-year recession like they did in the early 90s. You think land prices are bad right now? You think asset value prices are bad right now? What would the global agricultural and asset markets do to valuations for assets if China had a 2-year recession of the similar magnitude as they did in the early 1990s? It would really be a major shock to the expectations of what things are worth. Commodity prices, oil, chemical, copper, metal, you name it, would suddenly fluctuate tremendously because of that volatility. Once again, is that a forecast? No. That is a caution about dealing with the scenario. Now, what about their currency? Because let's talk about this relationship again. Florida is not nearly as impacted as California and the Midwest by the Chinese growth yet. But don't kid yourself, it's going to touch you on a go-forward basis. Go back to what happened in the early 1990s. What did China do when it had a major recession? 1991. It had an immense devaluation of its currency to do what? To make it more competitive on a go-forward basis for exports. Can China do the same thing today? If China gets into a recession and wants to grow their export or protect their export base, can they devalue their currency on the same level? I don't know. Now, my two favorite answers as an economist is I don't know and I was wrong, okay? Yet I still have a job. Isn't that amazing? But think about that. All these connection points. What would China do? What would the currency or exchange rates be? What would the interest rates do as a buyer of treasuries if they were trying to do that to us? Now look at the impact that China's had on the global markets so far. Primarily they've been oilseed buyers. China has not been a major food importer. China for the last 20 years has said food's a strategic security issue to us. We're not going to be major food buyers. We're going to be self-sufficient. Guess what? They couldn't make that happen in oil seeds. Whether it's soybeans or rapeseed oil or palm oil, China needs a lot of cooking oil for its population. But this is changing. Here's my major prediction for agriculture going forward. China's next step up is they're going to keep buying more oil seeds, but we're going to see an explosion of grain and other food imports into China. China is basically going to abandon their desire to be a net zero exporter-importer of food. They're going to go to become a major food importer on a go-forward basis. And the impact has already been huge in this market. It's only going to get bigger. And you think about all the connection points. Everything's connected, we just don't know how. You're growing food, you think exclusively for the U.S. domestic markets? Not true. It's going to be affected by what's happening here. A lot of numbers up here. But what this is the USDA's estimate of how much Chinese people eat, or around different countries, per capita meat consumption. Look at that. I cut it off where China comes in. They're underneath Jamaica, that economic superpower when it comes to meat consumption, right? What would happen if China wants to go to EU levels of meat consumption? What would happen if they want to go to US levels of meat consumption? What's going to happen is an explosive growth in that grain market on a go-forward basis. So once again, we are just not prepared for the amount of influence that's coming in via these trade relationships into our agricultural commodities. What else are we seeing here? 4 things I want to talk about. Why won't we have ability to predict the future when it comes to the economy? Fiscal spending, monetary policy, and the exchange rate. And the exchange rate is almost a function of the first 2 elements. And then biofuels is a big issue as well for ag. Think about this. Look what we earn as a government. Look what we spend as a government. Who in this room is a banker? Show of hands, Wells Fargo bankers. Who wants to put this credit in front of the credit committee? Who wants to put their name on that credit application? Think about that. Would you really want to try to get somebody financed who's spending $1.5 trillion more a year than they're earning? That's a pretty bad situation. And look at the impact. We heard a little bit about this last night. Look at the impact on Treasury debt. Look at the explosive growth that we've had in debt that the government owes to other people. In particular, look at that green component at the bottom, foreign Treasury debt held. That's an amazing growth as well over the last 4 to 5 years. And don't kid yourselves. Foreign Treasury debt is held for one reason only by most of these foreign countries, so that they can protect their currency exchange rates. Why does China now have $1 trillion worth of U.S. debt? It's not because they love us. is because, going back to the slides we saw earlier, the only way they can keep that yuan relationship stable is by absorbing so many excess dollars and then putting them outside the country into Treasury debt. They have almost no options. If they want to run the trade surplus they're currently running with us, they need to accumulate Treasury debt. You think they're happy accumulating Treasury debt at under 2% on a 10-year Treasury yield? Probably not. But you think about all this debt out there and what's going to happen with it, it's another reason why you have to say to yourself, no one's going to forecast what's going to happen in this economy. How about employment? That's the topic that's on everybody's minds right now. How do we get more people employed? Look at the employment numbers that we've had over the last decade. We're still back where we were in 2000. We've lost an entire decade's worth of employment during this last cycle. That's amazing. That's why nobody's happy. That's why this is not going to be a sustainable economy on a go-forward basis as you get more jobs going. Here's the problem, though. Typically, jobs and capital spending, that important component we just heard about earlier, go hand in hand. We have pretty good capital spending going on right now. For everything you hear, we're seeing capital spending rates recover at a pretty good rate compared to where they were earlier. But yet, you go back and look at the employment number, it matches pretty well until you get to the last couple of years where we had a lot of capital spending going on, much more than a lot of people anticipated, but no jobs related to it. Why? Well, because people don't like employing other people. We've made it very expensive to keep people. Look at the growth in wages and salaries on a per hour basis. That's a lot. If you're an employer, you know what I'm talking about. It's the benefits and the wages. They're going up 4.4% on an annual basis, 2.5%, 6% plus in terms of real cost of employment. That's not easy to deal with. So what are people doing? When they make these investments, it's all about automation and labor savings, because they don't want to hire more people if they can avoid it, because they know what they're going to face on an ongoing basis for having those people there. So the government has a kind of a love-hate relationship going on with this relationship. They want more investment, but the investment's going towards automation and productivity gains. So no one's happy. What we're seeing here is we have not been able to knock that initial jobless claim numbers down to that 350 level or 300,000 level on a go-forward basis. And it's not going to happen until employers think that it's more advantageous to hire people than look for automation and productivity gains. And that's probably the biggest problem we have right now. Labor is simply too expensive on a go-forward basis for this economy. And nobody wants to say that. What kind of politician wants to say that labor is too expensive? No, they want to claim something else other than the basic fundamental of capital versus labor in this market. So let's finish up, talk a little about some impact of this situation, the lack of job growth on food. Now, this is a complicated chart. There's a lot of things going on, and I want to apologize for it. But I think it's important to think about the impact. Who in this room has any ties to Florida dairy agriculture? Okay. Well, this is very important for you to think about then. Because what we have on here are two things. The red line, which is on the right-hand side, is the price of milk at the supermarkets. So you can see that's the price per gallon, the red dots. And then the black line is U.S. milk consumption. We've seen U.S. milk consumption plunge below 2005 levels. We're back to levels that we haven't seen in decades. People are drinking way less milk right now. Why? Because milk prices are closing in on all-time record highs, and with the lack of income, we're seeing a huge impact on the food consumption. Now, most of the people in this room are not dairy operators. So why is this chart important to you as well? It's because we get a lot of high-frequency data on dairy consumption. We track it very closely because we have the data. The problem for a lot of people who are selling other fruits and vegetables, you don't get the same data. But this is happening in your markets as well. I guarantee you that when you look at the impact of this income effect on food consumption, it's negative. It has to be, because people are having to balance their budgets, and one of the things they're doing is taking out food consumption. As much as they don't want to say it, it's happening. We can see it very clearly in dairy because we get monthly dairy estimates all the time from the USDA. We don't get the same type of clear data in a lot of the fruits and vegetable markets, but it's happening here. Where else are we seeing it? In the protein markets. Look at the projected impact on beef consumption and broiler consumption. Now, these are USDA historical and estimates. I think that might be overly optimistic. I think they're going to have even bigger impact on some of the meat consumption as well. So the problem that we have in agriculture is we have this dynamic shifting going on. More and more of our demand is coming from overseas, which is highly unstable, highly unpredictable, and more we're seeing this income effect really hammering our domestic food consumption. Now, is that good news? I apologize for coming here today and not giving you good news. I don't have any good news to give you, but I think it's fair warning that we have to look at the change in the dynamics of this system and think about those sources of volatility. So, what's in store? I think falling real income right now, we've seen it for the last couple of years, until we see strong job growth, and that's a very difficult thing to see happening here in the next year or two, you're going to see a bigger hit on an ongoing basis for discretionary food consumption. And once you lose that per capita demand, it's very difficult to rebuild. So I think this has to start going into our mentality as food producers and as agricultural suppliers of what do we need to do to be ready for that environment. Competition, absolutely. And then the housing market. There's no quick recovery on site. And so in the things that we're talking about that relate into the housing market, we're still at least a couple of years out from that. So I think when you think of what's driving Florida agriculture, these incredible strong shifts in linkages between global demand and domestic demand are really going to have that impact. Now with that, let's talk about what we can do about it. Don't predict, plan on scenarios. Why do I want to say that? Well, bankers love to see, forecasts for your P&L and stuff like that. Great. But what's more important is for you to understand the true dynamics of what drive your profitability and be able to show what you would do in all these different possible scenarios. I used to compare economists to drunken monkeys throwing darts, but I can no longer do so because PETA has a restraining order on me. They said I was slandering the drunken monkeys. They don't want to be compared to economists anymore. But we're going to see these things, and what do you have to work with? Working capital and margin management. More and more we're seeing a real strong push to find how can we do more risk sharing in the industries, either through futures or tolling or other cost risk sharing. Not always a pleasant situation, right? Because sometimes when you do risk sharing, you also give up some of the upside. Asset pricing. Another key element. People in this room are often very asset heavy when it comes to agricultural assets. And let's think about what we've seen. We've seen an incredible decline in the real cost of financing those assets, which has allowed the cash flow, which has been fairly good in a lot of the different Florida agricultural products, to be more valuable. That has to stop, and it will be reversed on a go-forward basis. Is that next year? I don't know. But at some point, this inflation is certainly going to overwhelm the Federal Reserve's desire to keep money at zero. And once real interest rates start rising and nominal interest rates start rising, you're going to see a reversal of this expansion of multiples to more of a compression of multiples on cash flow. We need to anticipate that. It will happen. It's not something you can say is going to happen in July of next year or even the year after that. But we know when you look at decade cycles, it's going to be a major thing, and we want to be ready for it. So, in agriculture today here in Florida, the most important thing we need to do is stop thinking about ourselves as being in a particular sector. You need to stop saying, I do X. No, you're part of the global agricultural food markets that's just connected to everything else. And you need to have that ability to say, I won't be able to predict it, but I will deal with it. Now let me stop there. I think that's my last slide. So any questions, concerns, complaints? This hopefully pushes back on you a little bit. Yes?
Could you talk a little bit about utilizing indexing and to establish long-term contracts?
Give me a product that you'd be concerned with.
Potatoes.
Potatoes. And who's your buyer?
Chip company.
Chip company. Okay. So are they coming to you, offer you indexes right now, or you want to try to offer them an index?
It's being utilized in some areas, but it's a cost-based indexing. There's all kinds of different things you can index off of.
Right.
And I think the government has a indice rating. I'm not real familiar with it. I just wanted you to speak about potential indexing tools.
Well, we're seeing a lot of that from the food companies because it's a great question because, for example, earlier this year, General Mills came to us because we're a large dairy financer. And they said, we want to get dairymen to sell us milk 5 to 7 years out in advance. And we'd like to know the price. Well, the same with your chip guys, right? Because they have public earnings statements they're going to make on a quarterly basis, and they would like to be able to tell the market they know what the price of their potatoes are going to be, a year from now, 2 years from now. And so what they're coming to you as a supplier saying is, well, will you sell me potatoes on a contract index basis where I can calculate what's going to cost me today, lay off my risk via some hedge, and then set my pricing? So we're seeing a lot of public companies really looking for ways to do more risk sharing with suppliers. What's the problem that we run into? For example, in the dairy example, the dairymen say to us, well, what's corn going to cost me in 2014? When we say, well, there's a futures contract, why don't you deal with that? Like your index, what do you reference to? And they say, well, geez, I really don't want to buy corn today on a futures basis so I can sell milk in the future. It just doesn't feel right to me. So when companies are coming to you and talking about doing an index-based thing where they're saying, well, fertilizer, land, water, we'll look at those prices, we'll look at a cost structure to come into those prices. If you can lock in those prices, you should know what kind of profits you're going to make today. And you're saying, well, what about yield? What about other things that are in there? So the indexing is an ongoing part of this pressure from companies, at the restaurant chain level, at the supermarket chain level. They want to be able to fix their prices further into the future. And they're hoping that agriculture today can solve that problem for them. But we're running into a couple of issues. Fertilizer's volatile, diesel's volatile, right? Yields are volatile. And so there's an ongoing struggle going on with the indexing to say, how do you really share the risk without putting it unfairly on one side, typically the farmer side of the transaction? And that's not easy to do, but there's a lot of opportunity there because the people that get to some kind of indexing faster that can reduce some of their uncertainty have a couple advantages. This is what I would see. I would say, if you know indexing or risk sharing with a future sale going forward, you might be able to reduce how much working capital you need because you won't have to just retain tons and tons of working capital for all the price volatility of the inputs and the outputs. If you can reduce your working capital per unit, whether it's an acre or a ton or whatever you want to specify, you might be able to out-expand your competitor because if he has to retain 3 times as much cash just to deal with the uncertainty, and you can reduce that amount of cash you need on hand, you can take that cash and put it into other assets that will allow you to expand. So we're seeing a lot of that risk-sharing, totaling going on, the indexing as you referred to it. But we really want to make sure that there's a good handle on what's driving it. That's a good question. Thank you very much. Any other questions, concerns? No? Then back over to you, Mike. Thank you very much.